This LOS is describe accounting warning signs and methods for detecting manipulation of information in financial reports. So we're continuing with detection of financial reporting quality issues, and now we're looking for warning signs. So some of the warning signs we need to be looking at is 1, pay attention to revenue. 2, pay attention to signals from inventories. 3, pay attention to capitalization policies and deferred costs. 4, pay attention to the relationship of cash flows and net income. And finally, 5, look for other potential warning signs. So a quick practice question. A pharmaceutical company has been very successful for the past several years, increasing its sales manyfold over that of its competition. It has been able to meet or beat analysts' optimistic quarterly earnings estimates and consistently registers very high sales towards the end of each quarter. Most of the company's sales are to 2 of its major wholesalers. The firm covers the carrying costs for these 2 wholesalers and guarantees them a return on investment until the wholesalers sell the products. Which of the following 3 risk factors related to fraudulent financial reporting would best explain the behavior of this company? A, opportunities, B, incentives and pressures, or C, attitudes, rationalizations? The correct answer is B. The motivation behind the activity is most likely the pressure to meet the expectations of investment analysts to meet ever-increasing sales growth forecasts. Another practice question. An analyst has made 3 observations in his worksheets about a company that he is reviewing. Which of these observations most likely reduce the quality of earnings of the company? The company A reported for the first time an asset titled Deferred Customer Acquisition Costs. B has reduced its estimated of the expected useful life of computer equipment from 8 years to 5 years. C entered into long-term leases for manufacturing equipment instead of purchasing it and recorded the leases as capital leases. Okay, this question was pretty easy actually. A is correct. An asset such as deferred acquisition costs could indicate the company is deferring current period expenses to future periods, which is a warning sign and an indication of lower quality earnings. If we look at B, reducing its estimate of expected useful life, that would increase the depreciation expense. And if you entered into long-term leases and you've recorded the leases as capital leases, you would have the asset and you'd have the liability on the balance sheet. So that's not reducing the quality of earnings. So I'm just going to finish this LOS and indeed this reading with a screenshot of the ebook, the textbook on my screen. And I just wanted to remind candidates, we didn't go through, I had a lot of bullet points, but not all the detail. And it is important to go back to the text and look at the tables and review in more detail some of the bullet points to consolidate and improve your understanding. So I just want to show you that there's a very good table here, choices that affect financial reporting. So you've got the area, the choice, the estimate, and then it runs through the analyst concerns. So of course we start with revenue recognition, and it's got some questions there with regards to the quality of the revenue recognition. Next is the long-lived assets depreciation policies. Then we have intangible capitalization policies, allowance for doubtful accounts, loan loss reserves, inventory cost methods. We've talked about that before. Tax asset valuation accounts. Okay, there's some information in there, and a question on the exam could come from any of these bullet points. It's just I'm not going to go through them one by one, but I'm just encouraging you to go into the text and review them. Some issues with regards to goodwill, warranty reserves, related party transactions, and then finally after that, the very next section is the warning signs, and that's what we've just been talking about with regards to this last LOS. So as we said, pay attention to revenue. I had some bullet points, but again, here is some more information with regards to paying attention to the revenue. And scroll down, pay attention to signals from inventories, pay attention to capitalization policies and deferred costs. Okay, pay attention to the relationship of cash flow and net income, and some other potential warning signs. You can see there's quite a long list here: depreciation methods, fourth quarter surprises, presence of related party transactions, non-operating income or one-sided, classification of expenses. Again, my slides and videos are meant to be a review, not just learning everything for the first time. It's also important to go into the text and make sure that you've gone through everything at least once, okay? So you can see there's a lot. I just wanted to point out there's a long list here. My slides are just a review, and if we look at the warning signs, quite a bit to review there, but nothing too difficult. You just have to go through it, okay? And then finally, that was the conclusion on the reading for financial reporting quality, okay? And that's the last for this LOS. Thank you.